Okay, we're
All right,
good.
I'm gonna let everybody in.
Let's do it. Do.
All right. Good evening, everyone.
Hey.
Happy Labor Day.
Yes.
Doing a little late night. Well, sort of late. I guess if you're East Coast, it's late night. If you're West Coast, it's not so late.
Yeah, but if you're in Hawaii, it's lunchtime.
Yeah, that's true. That's true.
You're in China, it's breakfast the next day.
Yep. Cool. I'm going to spotlight you, and I'm going to spotlight me.
All right.
Add spotlight, so we're spotlighted.
Nice.
If everybody real quick put in the chat if you can hear us okay, that would be great. Or a couple people, just make sure our mics are working. And I should move my mic over here. Okay. So tonight we're going to go over a deal or no deal on a property that Nick and I worked on. There was some pros. There was some it's a really good deal. And a lot of things went wrong, and the reason we're sharing this deal is there's a lot of things that went wrong in regards to how the investor that we're working with structured the deal with title, just like a lot of things. But the positive sides are, we want to talk about where the deal came from, how they found the deal, how they marketed the deal, how they exited out of the deal, how they funded the deal, the whole
9 yards.
The whole 9 yards. So
yeah,
the
let's
cash,
do
the cash now,
Q&A.
cash flow, cash later model. What's that?
Yeah, let's do the Q&A first, get that out of the way.
Okay.
And then we'll jump into it and go from there. So let's see here. It says, do we have access to the deal calculator spreadsheet in Google Drive, the crunch numbers? Yeah, well, it's there. It's under cashflowdealmachine.com. Somebody, we can put that in the chat. I mean, we should know where it is. It's also, I believe there's a link in the Facebook group as well. And it's definitely in the resources. So three places it should be.
I'll put it in the chat too.
Yeah, cash flow deal machine. Then just follow the instructions. We're going to be doing, there's another version of it coming out probably in about a week. Gonna do some updates and some modifications to it. Just enhancement. It doesn't change it from what it does right now. Okay, let's see here. Says, I own a seller finance home, ARV 320. I pay my seller $1,100, which includes PITA and solar lease. I need to give her $60,000 for the equity, plus I need $20,000 down payment payback. This is a cash flow. So this is from Michelle Evans. I don't know if Michelle's on the call, but this goes for anybody. Just fill out the model and submit it. Okay, and if you're a member, we'll record it. We'll record a little video overview, like a Loom video, and send it back to you. If you're a paid member. If you're not a paid member, you can still do the same thing, and you submit it, and we'll do it on the deal, or Neil do it on a Monday night off, or whenever we do office hours live, and do a deal or no deal. And then there's instructions for all that. And that's all in the resources that tells you exactly how to do it, how to submit, depending on what kind of deal it is. If you already got it under contract, if you go into transaction management, and maybe we'll even pull that up and go through it. But it's all, we don't have Elvia here tonight, but I'm on a different screen, so I can't even access that right now. But it's pretty straightforward and self-explanatory on exactly what to do. But most importantly, you have to follow the instructions. We have almost 5,000 people in the group now. If you don't follow the instructions, it will not get processed. I can promise you. Okay. And it's not that we don't want to do it, it's we just can't be babysitting. You know, you guys got to follow the instructions, and we say, save it, name it, do it, and send it to this email address, and make sure all the stuff's there. It has to be done that way, because it's not fair to everybody else involved to tie up the time that it takes to go fix a problem that's really easy to just follow the instructions. So please do that. Let's see here. So ever since I love reading these, because I don't know these in advance, so they read a little funny sometimes. Ever since I heard the strategy on a podcast, I can't stop thinking about it and how to implement it. That being said, one of the biggest unknowns for me is, are there many buyers in my area that need owner financing at 8 to 10%? And thoughts on how to do market research. So let me tell you a funny story. I'm in the process right now. I haven't even told Eric this. So I'm in the process. Oh, I think we talked about it last week on another call, that I'm in the process of buying trying to acquire a $14 million portfolio in Texas, right? So I had to call with the seller on the weekend. And this guy is way over my head. This guy is, he basically built this $14 million property, him and his partners. There's zero cost basis, zero. It started out 40 years ago as like a $250 property. And it just built and built, and they just kept trading up. And now it's where it is. So, I mean, I can't even answer some of the questions that he has. So, I mean, I got to bring the guns. But what's funny about it is I started asking about seller financing, because I go, what are you going to, because I'm going to take he goes, I'm going to take a big tax hit. I go, well, are you really? He goes, yeah. I go, well, let me ask you a question. If you gave me a 100-year balloon and you sold it to me, what's your tax implications on it? And he goes, there isn't one. I go, exactly. Well, but you're not going to give me 100 years on a balloon. I know that, but there could be something in between. Where I'm going with this is that he goes, these guys they get in their own way sometimes, right? They go, well, my banker says this, my banker says that. He goes, well, I goes, I guess I could sell or finance it. He goes, but I'd have to get at least 5 or 5.5%. That's what he's telling me. Okay, I got to at least get 5 or 5.5%. And I go, well, I told him straight up, I go, well, I'm not going to keep this as a rental portfolio after the tenants leave. I'm going to turn it into owner financing. So I told him. He goes, I didn't think about that. This guy's got hundreds of millions of dollars of assets. And he goes, I didn't even think about that. I go, well, I'm thinking about it.
Nick, how old is this guy?
He's probably 70, maybe 60.
Okay.
He's been in real estate for 40 years, he said.
So he's young. He's young.
He's young,
He's probably in a place now where if he would love to have one big fat note.
He wants to get rid of the single family, and he wants to go buy car washes or storage units or boat storage, whatever the heck it is. But my point is this. He goes, well, yeah, he's thinking this is where it's I'm just a long way around it, but people get in their own way of what reality truly is. Okay. And what I mean by that is he doesn't think the market would bear 6% or 7%. I'd pay him 7% right now. I know I'm going to sell it for 10%. If I could arbitrage 3 points on $14 million, run the numbers on that. And he's going to probably let me get in at 5.5 or 6. He has someone like that. My point is, yes, there's owner finances at 15% probably. There probably is. Okay. But that's not the challenge. The challenge isn't getting a buyer to say yes to the terms of the deal. The challenge is how do you going to structure it so when you exit out, you don't get crushed on the discount, you don't get crushed on value, on a lot of things like that. So the short answer is yes. And we talk about this all the time. And I know we have new people on each week, and some people have heard it and some have not. I mean, the market's probably 65 to 70% can't get a traditional bank loan. We talk about this all the time. There's your number. Go out and do it. I mean, we're going to talk about the deal, Eric, that we just did, and we'll talk about exactly how they found their guys, how they found their buyers. Look, guys, you only need one buyer to say yes to whatever it is you're selling. You don't need 100. You worry about the next deal when you get the next deal. So yes. Any thoughts on how to do market research on end buyers before jumping in? Yeah, the easiest thing to do is go post it on Facebook Marketplace. For sale by owner. What's the verbiage you use, Eric, to qualified buyer?
Owner will carry a qualified buyer with large down payment. I'll put it in the chat because it's very general, but it gives somebody let's see, I'll just put it in there. Owner will carry to qualified buyer with large down payment.
Yeah, if, you know, as a matter of fact, if
And
anybody
just so you
is
know,
actually,
large down payment could be 100,000 and it could be 1,000. You don't know.
you don't know, but you don't want to limit yourself to whatever it is.
No.
Hey,
you don't.
if you've ever posted, do me a favor, if you've ever posted anything on Facebook Marketplace for sale, raise your hand, because I want to ask a couple questions. I want to just raise your hand. I want to go through that in a second here after I get through a couple more of these questions. I mean, I know what it is for us, but you know, that's us. I mean, I want to hear what other people have to say on it. So let's see here. Yeah, don't get stuck in a corner with limiting beliefs on what. Here's the challenge most people have.
Well, yeah, Nick, 10% is going to go to 10.5 and 11 soon if the rates keep going up.
100% it will.
Because, and here's the cool thing, we're just going to keep getting better deals to be able to provide, because it's still got to be affordable. It's got to be it's got to still have the people still, the buyers still have to be able to afford the payment. Okay, so there is that, but it still makes sense.
Yeah, I think what you guys have to remember is that you have, and it took me a long time, a very, very long time to think differently about these kinds of these deals and these structures. You guys got to get out of your own way. I'm telling you, don't, just because you don't want to live in that house doesn't mean somebody else doesn't want to. Just because you think it looks like it's dilapidated and needs a bunch of work, other people don't see, they see it as their forever home. I'm telling you right now, because you don't know where they come from and you're what they're doing. Some people used to live in boxes on the street with no running water or heating and cooling. And to be able to come and have home ownership is a tremendous opportunity for a lot of people that are extremely appreciative and grateful for that to happen. And they make these houses. That's why I stopped doing rehabs, because they would come in and make these houses better looking than I would ever make them. 100%. They put more time, more money.
When we first met, we each other for a long time. That's why we part of deal maker. But your niche is years in, like I'm gonna convert the garage into a bedroom and a bath, make it a 3-2, and then I'm gonna sell it. Right now, we're finding 2-1s and doing nothing, and the buyer come in and add value to your asset. Exactly what you do. So you go buy a few months later, and you've got new landscaping package. You've got a tile roof instead of shingle. You've got the one-car carports, and now a bedroom and a full bath, and you got a guest house in the backyard. I mean, all of a sudden you're like, oh my gosh, people, so the thing, the mindset that Nick and I, share with you guys when you're on the call. There's some people on the call before is, we're going to provide homeownership to people that aren't able to get traditional bank financing. It's by finding good deals. We're finding good deals and be able to provide an arbitrage in the exit without having to do a ton of rehab. So
I asked the question. I just came back on screen because I was looking at the question. So no one's tried to market a house yet through Facebook Marketplace.
Yeah, Damon said.
Damon. I have, dude. It's you guys. Even if you don't have a house for sale, do it, because you will not believe what's going to happen. I'm gonna open up. I'm gonna ask Damian. I'm going to unmute yourself and tell us what you've done so far and what you found out from marketing to owner finance buyers.
Yeah, so I just went on the Facebook Marketplace and I just put I grabbed a quote that they used before. It's like dueño. So I did part Spanish and part English, and I kind of just marketed as far as the down payment that I was looking for, which was like around 12% down, and just kind of a little bit.
So here's a question. So
yeah.
So I always recommend marketing in Spanish and English, because that way you got it all covered, right? All the languages covered for 98% of people speak either English or Spanish in the country. I don't know how to translate Chinese or Japanese, so sorry, not gonna be able to help there. So where were you marketing this property?
This was in Mansfield, Texas.
Mansfield, Texas.
Or actually, this one was in Dallas.
What market are you in, Damon?
I am DFW.
So you're DFW. You found it local to DFW. So you posted up there. And what was the price point of this house? Like, what were you trying to sell?
That one was $360.
That's pretty good. I mean, that's on the higher end of of median home price. It's not.
Well, that was the price that I just put it as marketing out to.
Okay.
So yeah.
What happened when you, and what happened when you did that?
No, I got a lot of responses. So like that same day and the day after, people were hitting me up as far as, is it still available? Is this available? So yeah, they're money is I was doing it mainly as a ghost. I call it like a ghost ad at first to kind of see if I get some attention, to see if that was a good kind of price to put it at as far as getting on the contract. And so yeah.
But you wanted to see what the market would bear before you even actually bought the property.
Exactly. Yeah, to see if like my down payment was enough to cover everything and all that.
Gotcha. So, but getting back to the response,
Yeah.
you didn't have a response getting people to respond for owner financing on a $350,000 house.
Oh no, they did. They responded. They were like they were wondering if it was available. So I ended up kind of getting one family in there and vetting them out and going through the whole process with them. So it was pretty simple.
What'd you end up doing with it? Did you wrap it?
Yeah, I wrapped it.
And you just arbitraging and keeping how'd you acquire the property?
So this one was the lady, she was in Florida, and her father and dad were staying in that place, just staying there, and she just was paying 2 mortgages. And so she wanted to get it off her hands. So I subtued it and then just wrapped that.
So you subtuted, wrapped it, and now you're arbitraging. So what that means is, just for people don't know what it means, is that you're collecting a payment from your buyer, you wrap the underlying Wells Fargo, Bank of America, whatever it is, and you're making the payment to the bank, and you're collecting the payment from the buyer, and the difference is your spread. So in this situation, what's your net cash flow on that about?
It's $810.
$800. Yeah, because your underlying mortgage is probably in the
it was $1,250 was the mortgage, and then I end up not having to pay her monthly payments, so I just kind of broke it down throughout the terms, and then I end up just taking end up making it more easier for the seller to.
Did you write 2 notes? Did you write 2 notes, Damien?
No, I did 1.
You should have wrote 2 notes, man.
I didn't know about that, so that's why I'm here.
That's why you're here, man.
Don't ever write 1 note ever again.
Okay.
Even if I have no problem with the arbitrage, if you know what you're doing, okay? No problem with it whatsoever. Okay. But always write 2 notes, because it didn't cost you anything to write 2 notes. Because let's just take your example for a second. Let's just say 2 years goes by, 3 years goes by, whatever goes by, and seller gets, belligerent, doesn't like the fact that you got the mortgage in their name, or the note gets called. There's a lot of things that can happen. But at least when you have 2 notes, you can take that first note, you can sell it. Okay, sell it, get cash for that note, pay off underlying debt, and still stay in the deal with the second note. Okay.
What's the interest rate that you created on the first, just for the wrap link?
I think it was 7.5, or it was 8.
Right.
Everything was, I want to say it was 7.5 though.
Right. Okay.
Way too low, but that's okay. You're arbitraging, so you're going to be fine. But we don't want to write them that low. You
never want to write that low, especially when you create a first and second. The cool thing is you can create a first at that rate, and then at a higher rate, and have your second lien at a lower rate. So because the first lien, Nick and I are note buyers, we want to buy a first lien at, that's at between 9 and 10%, right? And so if you have it at 7.5% or 8% or whatever, you're gonna have to still take a discount on that thing. So you got to be careful. Now,
no buyer's going to want to have.
It sounds like you got a lot of spread in it anyway, so it's
okay. I mean, that's okay. It's still a good deal, and
still
you can run it out, and run it for as long as it goes, and then go do another 1 or 2 or 10 or 100. They're everywhere right now. So
how many 810s do you need? $810. I mean, to be financially free. That's why I love.
Well, here's a better question.
In our market.
Here's a better question. I think it's a better question. How many rental properties do you have to net $800 a month?
Yeah.
And what's the value of these properties to get the $800 a month?
Yeah.
I mean, if you had $1 million in real estate, can you get the $800 a month net?
It depends, but I mean, on a traditional median home price at 400,000 and under, it's really difficult, because you're putting 20% down typically, Like, how much money did
I
you
mean,
put
if you
down
do
on
the
that?
Burr model now and you have rates at 7%,
Yeah.
I mean, you cannot, there's, I mean, a $300,000 house cannot, I haven't done the math on it, but it cannot cash flow more than a couple $100 a month.
Hey, Nick, we could do, Damien, is, we want to go through this model, but maybe we'll bring you back on if we have a little extra time.
Okay.
And show how we would have structured that deal a little bit differently in our world. And so everything's done on the,
Did you ever put it in the model by chance? Did you ever take the model and take?
No,
your
I
deal?
did not.
It's a little
no.
tricky because I haven't modified it yet to let you take and put underlying debt in there. There's a whole nother model that we use for sub two and seller financing. This model that you have is more for a short term where you're using cash.
but we could get close. We could get close on it. I just like to see it. I always love to
Yeah,
share
that'd be
with the
great.
group the numbers, you know?
Yeah.
Yeah, that'd
All
be
right,
great.
cool. All right, let's go ahead and let me find this model and let's go through it real quick. Give me a second. Pull up my screen.
So while he's doing that, I'm gonna, so basically how this deal was found, it was a local investor here in Phoenix. And just so you guys know, like sometimes we'll share, I have addresses, sometimes I don't. Personally, I believe I don't mind sharing addresses, but sometimes I think it's personal, and people move in the house and whatever. So, we trust our group, but I just like to keep some of that private for just the borrower, to be honest with you. So with this particular deal, a local investor here in town, his whole business model is following up with rookie wholesalers and real estate agents that are having a hard time selling their properties. Okay. And there's a lot of them here in Phoenix, in the Phoenix market. They're everywhere. There's a lot of people out there that are really, they have deals that just not a lot of experience, maybe not a lot of money, but they have opportunity. So there's that, and there's realtors that are having a hard time selling their property. So that's that. So they also follow up. So they do the follow up and find out if these deals are falling out of escrow or what's going on. So there's a specific area in town that they're focusing on, and they're going through and following up with agents and wholesalers to see if they fall through. So then they also market in Spanish and English, and they've really put themselves in the Hispanic community, and so they know exactly what their buyers are looking for, and it doesn't have to be Hispanic, it could be anybody, but they know that their buyers, the buyers that they're working with, they're not going to go get traditional bank financing from Wells Fargo, from Bank of America, whatever, right? So that's their focus on that. And then so what they did when they sold the property, is they did a little bit of marketing on Facebook Marketplace, but their main market was their network of the community that they work with. And then they created some flyers and did some open houses. I think they only did one weekend of open houses. I think they did I think they only did one. Hang on a second, I'm trying to get somebody. That's weird. I can't get them in. Okay. So they did one weekend of open houses. They got quite a few people that were interested, and quite a few is an understatement. They got a lot of people interested in this particular property. And one of the reasons why is because even though it's a little 3-bedroom, 1 bath, they did the rehab. So when they took it down for we'll see here, and well, actually, why don't we walk through it? I just kind of want to give you guys kind of a
You see the screen?
Yeah, I can see your screen.
All right, so
I want to give you kind of a breakdown of what
here's what I'll do. I'll walk it through from on the sheet, and then so they bought it from 175, and you said they got it from they are a wholesaler, is that right? They bought it from a wholesaler.
They bought it from a.
What's their traditional? What is their what do they do in real estate? What's their
they fix and flip and wholesale. That's their model.
Yeah.
Until
So
now,
this is the first one they did like this, right?
No, because the challenge is I personally know them, and so I said you need to do this, and they're like okay, and they didn't go through any of the stuff that I sent them. They just kind of went,
right.
And that's why there was a challenge. But you'll see, even though with a challenge, it's still a freaking amazing deal.
Right.
So we're sharing this deal.
So they went and found it.
Literally just closed like I don't know, a couple days ago. So that's why
they bought it at 175. They sold it at 300.
Yep.
It looks like they did $25,000 in rehab.
Yep.
Okay. I would have been curious to see if they could have sold that at 250 and not done any rehab.
100%. And they figured that out when they did their marketing. They would have probably, now that they know, they have already 3 or 4 more houses that they're bringing up.
I would argue there's more buyers at 250 without rehab than there is at 300 with rehab.
And so the call, that rehab, that $25,000 pretty much lipstick. I mean,
You're cutting out a little bit. I think you are, unless it's me.
Is that better? Okay.
Yeah. Yeah.
So for the new people, the $25,000 worth is lipstick. So a traditional buyer, these buyers will go in a few $1,000s. It's probably unstable. It says it is though.
Yeah, I think it's you. So I'll go down here. So they put 25,000 in. Debatable. They should have put 5 or any money in. We don't really know. So we didn't see it before. They did get $40,000 down, which is a little over 13%, which is a good down payment.
Real quick. So here's what happened. If you guys can hear me, I know I'm having a little unstable internet. It's okay now. They did an open house, 2 open houses. They have their sales agents do it for them. And the buyer showed up the next day, because they did 2 days, the next day with 50,000 in cash in a bag. Yeah. And so they're like, yeah, well,
I think I told this once before. I was at the, I didn't, well, this one I used to go to title. I haven't gone to title company in for several hundreds of deals. So it was probably my first 100, maybe 200 deals I've ever done. And I was going in the title to pick up my promissory notes. I didn't like them to send them if I could pick them up. And so the title company calls me and Trish goes, "Hey, Nick, we got a problem." I go, "What do you mean we got a problem?" We go, "The buyer's here for the house on Arlington." I go, "Well, good, because they're supposed to be there." She goes, "Well, I go, what's the problem?" They go, they brought in cash for the closing. I go, "Well, they're supposed to bring in 20. They're supposed to bring in cash for it." No, what happened is I had sold it on terms, and they go, "Hey, how much do I just pay cash?" And they said it was like $82,000. This has been a while. I remember the number. So this has probably been at least 2015. So then she goes, I go, "Well, yeah, it's $82,000 cash. That's the contract, right?" She goes, "No, they literally brought in $82,000 cash." I go, "What?" I couldn't believe they brought in cash. I get there. Okay, this is the best part of it. I get there, and there's 2 title closing rooms, and they're in one. And she goes, she's in that closing room over there. And I walk in. I don't ever meet buyers ever. This is the only buyer that I can remember. Maybe there's 1 or 2 others that I actually ever met or ran across just in closings. And she's in there with 3 kids, all under the age of 5. And she's like 5 foot nothing. I mean, she's tiny as can be. And she's got this plastic grocery bag like you get from Fry's or Tom Thumb or Kroger or whatever it is. And she's got $82,000 cash in this freaking bag. And she goes, "I brought the money," and she gets it out. The funniest part about it is that they're like in 10,000 pack. They're $10,000 packs. She's got like 8 of them or whatever it is. And they're all wrapped with homemade money wraps that were made out of construction paper. And I just got this picture of the kids sitting at the kitchen table, cutting the damn construction paper so they could wrap the money. It's like, we got it done, but man, yeah,
but Nick, that reason why we do what we do is for that exact reason. There's a gal that saved up her money. She's got a couple kids. She's been renting her whole life. And 2 weeks prior to that, I promise you, she was a renter, and now she's a homeowner.
I bet you I didn't have $82,000 cash liquid at that point.
When you had your 2 kids when they were little.
Yeah, probably not.
Anyway, I mean, that's the point.
They're everywhere. I mean, I'm telling you, there's when I bring this up because I said it earlier in the call, is that you got to take your mind out yourself out of the equation. You can't think because just because you can't do it or will do it, that the opposite doesn't hold true. It's just not the way it works.
The
It just is
security
not.
of home ownership and not being a tenant, and knowing that, because these are 30-year loans, by the way, we're writing 30-year paper. It's the opportunity that people will have that security, for their family to own these properties and have a fixed payment. So anyway, so that's what happened. So they showed up with $50,000 in cash. And so that was
So let's talk about that. This is what I was going to say next. So let's talk about the first mistake, or a mistake. I don't want to say the first one because I don't know what order they went in. Who took where did the $50,000 go? It was physical cash, right? Real cash.
So then it got cut down to 40. So as you can see, there was a 40,000. So they took the seller, who's one of our investor friends, took the $10,000 and took it as earnest deposit and just went and put it in his bank account.
Physically took real cash.
Yeah.
Took cash.
Yeah.
Not a money order, not a cashier's check, not a wire.
No, which
Not
is
a personal check.
which we had a discussion about that. Don't do that. You go and get them.
Do not take cash.
Go get the earnest.
Never.
Go get a cashier's check.
You want to take $10 as an option fee? Fine.
Right.
$100, fine.
Right.
I mean, I don't even take that, to be quite honest with you.
No.
I never touch cash ever.
No.
There's no, just not, it's not, I don't need to touch it. So he took 10,000.
But here's where it got worse. So then the seller, our investor friend, had a title company that wouldn't let him wrap the hard money. And so
Why is that?
What's that?
Why?
I don't know. We went through this like 2 months ago.
Oh, I want you to answer the question. Why?
I don't know why.
Because they didn't know what the hell they were effing doing.
I know. So we had
So
long
this
discussions.
is important. Let's not go too fast.
Yeah.
So first mistake was they thought they were going to use their title company.
Yeah.
Wrong answer.
Yeah.
You don't use just any title company. The title company.
But Nick, this title company is a very successful, great real estate investing friendly title company.
You know what? I got the best cardiologist in the planet.
Yeah.
But I'm not going to let him do my ACL surgery, Eric. But he's still a physician. He's still a doctor.
Yeah.
Doesn't matter. You
Yeah.
can't, these, I'm telling you, just no different than just people not understanding the structuring of notes and the power of amortization. And the fact that investor said, well, 5% was a lot of money. And well, it may be in his world, but it's not in the owner finance world. They just don't know what they don't know. And to say that you can't wrap a mortgage is just ignorant, to be quite honest with you.
Well, anyway, we had to get them out of that title company to our title company that understands what we do and fix the problem for them. So that's
good.
That's
another problem we had to fix. Where did the $40,000 go?
So anyway, it went from 50 down to 40 down. Okay. So
right.
And they had to come up with another 30. No, the other 30, the other 30, they ended up taking that as well and deposit.
They take it in $100 bills and
I don't know.
Quarters, when they get it.
I don't know where. Well, the buyer gave him the money.
Gave the seller the money directly.
Yes.
Okay?
Yes.
Wrong answer again.
And the seller forgot to tell. So they went to closing, and the closing the settlement statement had the buyer coming in with all this money, and then the seller goes, "Oh yeah, I already have it." It's like, no, dude. No, and this is a pretty sophisticated investor. I was shocked. I'm like, dude, that is a horrible business plan.
Yeah, this happens all the time, guys. This is why we say you got to do 4 things: find the deal, analyze the deal, fund the deal, find the buyer, and then get the hell out of the way. Seriously. Seriously, because if you don't do that, it's going to cost you money in the form of time by having to manage that transaction yourself. But more importantly, it's going to cost you money in the discount on the note, or even worse, get yourself into a position from a legal perspective that you probably just don't want to be in. Okay. I'm not saying you did anything wrong, but you don't want to have that. You don't want to have that discussion. Okay.
If
It's not
something
worth-
went wrong, it would not be good. And the poor buyer, I mean, that's not what they do. It's probably it's clearly their first home they ever purchased.
What the
And-
hell
and-
if it,
and they
what if I-
literally
what-
they showed up with tears in their eyes because they're like, we've been waiting our whole lives to own a piece of America. Like,
shit,
have
what
a
if
home
some
on
of that
it.
money was counterfeit? How would you know?
Yeah, I don't know.
I mean, so my point is, don't do that. Okay,
Yeah.
let's get back into this. That's good. So you found it. So let's just go into the middle section here. In
Okay.
this little thing. So this one had they sold it for 300. The ZHVI was 258-ish.
So real quick, explain ZHVI to the new.
It's a Zillow Home Value Index. So if you want to know what it is, just go ZHVI and the zip code. If you're ever looking, just go to Google and do ZHVI, Zillow Home Value Index, and the zip code, and it'll give you a, I don't think this is it still here. I think I already left. No, I'm already gone. It'll tell you it is. Now, does it have any impact on the deal? No. I just like knowing where my house fits relative to the median home price for that specific zip code. Okay. That's it.
Just so you know, in the Phoenix market, I think our median home price is just a hair over 400 grand now. It's kind of fluctuating as the market changes. So
well, there's the market itself, but then there's also the zip code, right?
yes.
People live in certain areas of cities because of schools, for example, right?
Yep.
They want to be in a certain school. Well, guess what? If that zip code is in a school district, right? And people will sometimes want to be in that school, and sometimes they'll want to be, they don't have the money to be on the high side of it. The bottom line is, on this model, they found the buyer. Doesn't matter. And so that's the whole point of why it's here, is that they sold it for $300,000, and that's over the median home price. That's fine. The value was there. They sold it, not a problem. But I would have rather seen them selling it for 220, or have a property in that realm to be able to do it. But it worked fine. They got $40,000 down. That's over.
So real quick. So what they did is they put out bandit signs and open house signs. And
I was going to get to that when we get to the marketing here. Let's
cool.
go. Let's stay in order, and then we'll get to that, because that's down when we get to the. Well, we're almost there. So they said it. So they come in here. They found their buyer, and then they wrote. How do they come up with the first and second lien rate? I'm just curious. Of 10%. Did they just wing it?
No, I told, because that's what I told them to write it.
Okay. Okay.
Yep.
All right. So let's see here. Okay, sales commission you have in here is 0. So is that because they sold it themselves?
Yeah. So the cool thing about this deal is they sold it themselves. The buyer paid 40,000 down and all closing costs. They had no seller costs on the
Okay.
for anything. And that's probably why they dropped the price, that down payment a little bit, so they could just give them a number so they'd have the money to come in and close. I think that's why they did.
Okay.
Plus they wanted
All right, cool.
and they got a nice
We'll
second
go
lien.
back, and what we're gonna do, we'll get through this model.
Yep.
And then we're gonna go back and put it in as if you were to do it traditionally and see if it still works. And I'm pretty sure
Sure.
it does. So there's no commission, so they basically market it themselves.
Yep.
And how they did bandit signs, you said?
Yeah,
put it
so
on Facebook?
they did bandit signs, they did open
house.
houses, they marketed in both Spanish and English, and that's how they ended up doing.
Got it.
Through
Okay,
through
so
the-
that
through the
saved
door.
that saved them, that saved them $12,000.
Yeah,
Okay, so we'll see how that comes out here in the end. Okay, so let's go down here. So they wrote a 70% first. Okay, and then well, you can figure out the percentage. They got 40% down. So the second is the difference between the cash down and the first. So they wrote a first lien at 70%.
Yep.
We end up buying their first note. They cashed out of it, and they end up, in this example, they end up with about $12,000 cash. I thought they had more than that.
and then more than that, because there's all those other fees in there. You can.
Okay,
take
so
off.
you got to zero these out.
Yep.
So these all get zeroed out.
The funding interest doesn't, but yeah, that's about, yep. Yeah.
That's probably close enough.
Yes, it was almost 20 grand net. And I honestly
So here's a couple, so this is a good thing. So they made 19 in this example, assume this
Yep.
is accurate. I know it's pretty close. They
Real
made
cool.
$19,000 cash. They get a $50,000 second lien that's gonna pay them $439 a month. Okay? Not
Yep.
bad, not a bad deal. As to them fixing it. Now, I'm not a fan of them having it in their inventory for 147
Well,
days.
because of they did everything. They went rogue on us.
I get it, but that's not the point. The fact of the matter is, it took them 147 days.
Yeah, it's too long.
Okay, because if they would have listened, find the property, fund the property, sell the property, get out of the way, that would have been, they wouldn't have fixed it, and they wouldn't have probably, they wouldn't surely have had another 45 days of.
They
waiting
probably
to
could.
get it.
They probably could have done no rehab and sold it for 260 to 275 and
Yeah.
had been just fine.
There's
Yeah.
nothing wrong with doing the rehab, but I'm just
No.
saying, I'm way more concerned about the fact that they took cash, the fact that the title company didn't know what the hell they were doing, the fact that they didn't, structure the things the way we want. Because the question now becomes, here, let's just say this deal, do you really want $19,000 cash? Okay, because we can always take less cash by changing the note ratio so that we don't have to pay this discount, because they paid 10% discount. Look, it says it right here. It cost, they sold it for 189 and it was a 210 value, because there's time value money, there's risk, there's things like that. If you don't believe me, go try to sell a note and tell me what you can get on the open market. I can promise you that 90% of the time, our offer price will be greater than what the market will bear, unless you sell it to your friends and family and you sell it to them, through an IRA or something like that. Then you might be able to get them, you might get it, but traditional note buyers, they're not going to outperform, they're not going to pay less of a discount. So you can obviously adjust that. So let's see here. What else were you on here? And then I want to go change it. They're $469 a day. This is a good deal. Obviously this is a really good deal.
This deal you would rinse and repeat forever, like it over and over and
Yeah.
over and over and over and over again. Like, how many 439s do you need? And here's the best part. Now that this is and it's funny. I was listening to, I'm not a huge Dave Ramsey fan, but I was listening the other day, and he said that he was he's like, I pay off all my real estate, and he's got a ton of real estate now. He makes his money with his business, and he invests in mutual funds. And so that's his thing. Well, because he pays off all his properties in cash, he doesn't have any risk, and there's no stress. Well, guess what these guys don't have right now? Any debt. They don't have any debt. They made almost $20,000, $40,000, $50,000 second lien, and they have no debt. So if there's fluctuation, whatever, they don't owe anyone any money.
Yeah. So they made $19,000 cash now.
Yep.
The cash flow is going to be $439 a month.
Yep.
And the cash later is, if you look at the second lien value, over down here, it should be right here. 10-year payout. This deal right here, this line, I'm just going to highlight it right here. This bottom line right here. Total value of this in 10 years is $117,000.
So here's the coolest thing. Okay. So they just paid them just $439 a month for 120 months. And at the end of 120 months, they still have to pay you the $45,000. They still owe you $45,000 on a $50,000 note. That's our appreciation. Amortization is our appreciation. It's the best model ever, being the bank.
The difference though is that your properties can go up and down in value. Guess what doesn't go up and down in value? My note.
Yeah, the note.
My value, my balance is my balance.
And here's the thing. This is an owner occupant that put down real hard, real money, 40,000, and has an affordable payment. They're getting principal pay down. They're very happy. And regardless of fluctuation in the market, right now in this market particularly, moving is not a good deal for them, regardless of the value of the house, because they're going to go pay more in rent, most likely. So that's
I'm gonna duplicate this real quick. I'm gonna do that. I'm gonna go back now. So this is, we'll toggle back on this. What I want to do is I want to go in and show it as the traditional model. So let's go up here. So traditional model.
So so this is part of Nick and I's model. It's like, when you get out of the way, meaning outsource if you outsourced everything and paid full commission, full hard money, full everything, what would this end up doing? I think that's what you're going to do right now.
Yeah, I'm just gonna see what it is. I hope I can get them all. Financing costs. Let's see, 2.9.
Oh, you're going 12.9. Wow. It's aggressive.
Well, it's what the market charges right now.
Your market.
Just go shop it. Let's see.
It is actually hard money is going up, by the way, because rates went up. So that's what's happening. But
Let's change this down to.
so this particular investor, they're so happy with what they did, even though they took them forever and they did some things that they shouldn't that we wouldn't have done. I'm not saying they didn't do anything wrong, but they're just now they're gonna, this is their model. They're not there's no more. They have their network. They work with a lot of realtors. And they work with a lot of wholesalers that just they're not the big guys in town, but they're out there with deals. They just don't have the expertise to exit them out. And this is what and they have a specific market that they're focusing on, specific couple of zip codes, and they have buyers. So here's what happened. Maybe I didn't mention this. They got 80 people that wanted to buy this house. This particular buyer, they felt the most comfortable with. And so we figured it out. Actually,
They had a bunch of cash and they said, just take my money.
Well, I don't know what their reasoning was, but that they liked this buyer. They felt good about it. And so maybe she showed up with her cash and was crying, was so happy to have this house. But my point is, so we took, let's just say it's 80. Let's say you break it down to 20 people that had between 40 and 50,000 in cash, which is what happened with this particular house. It's a small little house. And so now they have 19 more houses to go buy for this community. That's so now they have $40,000 to $50,000 down.
Yeah, it's like pre-selling the development. You put one.
So now their team's job now is to go. They already found 4 more houses. They already have 4 more.
But
houses.
Eric, Eric, don't you think those buyers are going to run out and buy something else?
Probably not, because they don't have. There's not that many houses that are available with seller financing like we offer.
Exactly.
Yeah.
We know that less than 5% of the market is available with seller financing.
So these guys are going to have enough to do between now and Christmas, basically, to provide to find houses in a market that's having some fluctuation. So it's going to be, I mean, they might find sub 2. They might do a lot of cool things. Like Damian did the ultimate, which is the arbitrage on sub 2, which, why not, right? Make the offer. You never know if they're going to take it. And he probably took that off somebody's hands that was obviously paying a mortgage and not getting paid. So that's the ultimate opportunity. Did you fill it all out now?
Yeah, I think it's pretty close. So
now you got 13,000 in net cash.
So now it goes down. We dropped from 19 to 13. Right?
Now, did you stick to the 25,000 rehab too?
I just left it in there because I don't want
left it. That's fine. Okay.
Because they already spent it. Okay.
Yeah.
But here's the difference. So the note ratio is 72 now, and it's left it at 90. Okay. But let's look at this cash for a second here. So now it's going to go down to 99,810. Before it was 117. Well, that was because they didn't have interest rate on. Here's my problem with the way that model was done personally. Even though they had they did the sales commission themselves, I would still want to see it in there, and they need to treat it as an expense. Just like if you use cash to do these deals, which I highly recommend against, you need to charge yourself interest, because if you don't put those numbers into the model, you don't get a good understanding of really truly what the deal represents. Because I don't want you guys to come in and change and go, well, I'll sell it myself. Well, what if you can't sell it yourself? Okay. That's a big number that's in there. In this situation, it's 12 grand. So I don't want you to model it with saying I'll just sell it myself to make the model work. Okay. That's not what this is about. That's why I'd rather leave it in here. So the model shows that right now. So let's just go here. So in this model, it's still a good deal. I mean, it's $13,000 cash now, $386 in cash flow. And then, the second lien note balance in the future is about 40,313, total 100 grand. Now, here's the question, okay? This is what you guys need to ask yourself. Do I want $13,000 cash? Okay. Or are you okay being, do you want less cash, more cash flow? It's a personal opinion, right? Because if you don't want cash, okay, or as much cash of it, because remember, that's short-term capital gains on that stuff. It's expensive. It's expensive money to take out, okay? So, but if you need the cash transactionally to do your business, and you have to use it, okay? But let's just say you didn't want this. So let's just say you wanted to get this closer to zero, okay? Well, what you do then is you come up to this note ratio and you just start changing it and going down until this number gets closer to zero, okay? So 68%, and I'll show you what that means. So probably 67 is probably the number.
That'll
That's
get you
probably
close. So it costs you 300 bucks to get a $50,000,
But look what happened.
$59,000 second
Look
lien.
what happened to your cash flow. It went up $140, right? Wasn't it 386? Now it's 518.
Do
Okay.
you want, hey, Nick, do you want to bring up the partial, like what we just did on a couple deals on what, because now you leverage now, because you can go get you can go get probably 50% or even 35% of that.
Yeah, we're working on that now. I don't want to bring it up now because I don't have the exact numbers in this.
But you can go do a partial, which is leveraging your note. And now you're borrowing against your existing debt. And it depends on the interest rate and what the partial buyer wants, but that's a good thing. Hey, real quick, Nick. So Stephen or Stefan, he said, where did the $40,000 go since you said they only got 18,000? So just real quick. So the 18,000 was basically their spread on when they sold the first lien and created the second lien. Because keep in mind, they were into this property for about 210,000 after all their hard money costs. And they got a $40,000 down payment. Okay. But they sold the second lien. So it cost them, they sold the first lien. The discount was about 20,000. So they're still left with that 18,000 and the $40,000 second lien.
In there. You have cost of capital in here. You have transaction management fee in here.
So real quick, they got the 18 and the 40. The 40 is their second lien that they're getting the cash flow from.
The 14, the net cash is the 18. So it cost them $22,000 in expenses to close it, loan discount. They got
a $40,000 down payment. Yeah.
They took $21,000 in the discount right here.
Yeah.
Okay. There's 21 there. There's these other costs right here. You know, it's not, I mean, discounts. But here's the thing. This is what notes were weird. Today, they're worth less. Okay. Let me show you on the amortization table. I think this is the better thing to do. It's really, let me find this here. Let's pull this up. So that one was 210 and they sold it for 189. So what you got to think about how time value of money works and risk. Okay. There's no note. There's no history on the buyer, right? So the note the home buyer.
We bought this note. We bought this note within days of the closing of the first lien.
But we don't know.
But it was fully underwritten. So what they did, this is why they were able to get why we were able to pay them what we paid them was because we did all the doc prep. We did everything. So basically in Arizona, Texas, Tennessee, I think there's our main right now because we wrote the docs. So they were the lender, right? So they sold it. Created a first and second. The note was written on our paper. That's why. So as soon as it closed, there was nothing for us to do other than
let's see.
Transfer it.
So this was sold for a yield, right? So
yeah,
they sold it for 210, 1849. So if I go in here and I put what we paid for it, this is what's really important to understand. Because there's risk, there's time value money, and there's risk, and there's the investment to value. I'm going to solve what's that?
Yeah, but think about this. If that was a $250,000 note instead of a 210 note, the discount's probably 25%, not 10.
But I didn't get that much value. But here's what you got to look at. You guys can't look at it down the dollar value.
Yeah.
Because the yield is only 11.31.
Yeah.
That's what we bought. We bought the yield.
Yep.
Okay. Because I paid $189,000 for it. The payment didn't change. And I saw for the return, the yield, 11.31. Okay. So investors on non-performing, it's not really non-performing, unseasoned paper, Now, you could wait 9 months and now you probably get another 3 or 4 points. The problem with that
What-
is if your borrower doesn't perform, you're gonna lose 5 or 6 points.
And
Right.
how many of our borrowers are performing right now?
Well, they all perform.
They're all doing really, really well.
Yeah, but
Doing
that's, but that doesn't change the fact that from somebody that's gonna look to buy the note,
No,
they
yeah,
don't know that. So that's
Yeah.
why, it's why you gotta do it. But look, so let's just go to this, that now look at what this buyer's gonna pay, or what they're gonna pay us over this time, $663,000. So
over 30 years.
it's over a 3x return. So that's why you want to hold on to this. So like this, let's go, what was that second
But
lien?
the best part, the second lien was 40,000, and that's why you want a bunch of 40,000s with no cost. That's what you want. It's
So a
great.
$40,000, let's just see what it's worth. 40,000, remember, this is the profit on the deal, right? So that's gonna get you $351 a month. Look at the value of what it's worth. It's not worth $40,000, guys. It's worth 126 over time
Yeah.
with no debt or no cost basis. That's why you want this number to be as big as possible and the first lien to be, in my opinion, as small as possible, but you got to get cash. I get it. But by doing that, that's what allows you to see.
The one thing that I love about this model is that blows away the Burr model is I don't owe anyone any money. Like it just, to me, it just, and I already have a predictable return on my money. So now, yes, if there's a fluctuation in the market and there's a decline or whatever, there's risk, but we don't have any cost in it. So that's good.
Yeah. All right. So let's, oh, my bad. Hit the wrong button there. All right. So let's go to the questions and see what we got here.
Yeah, so I hope Steven, if you want to put in the chat if we answered your question, that would be great. And then so Jose has second question. Do you need to acquire at 70% of ARV for the first lien to extinguish the hard money loan? Okay, good question. And second, how do you sell at ARV and have RMLO get appraisal if no repairs are done? So the best part is, guess who's the bank? You are. So that's
There's no appraisal required. First of all,
No.
but a note buyer is going to want to know what the true value is, but it doesn't have to be it doesn't have to be an ARV appraisal. It could be an as-is appraisal,
yeah.
right? And that's the other reason. Let me go back and share the screen again here. Let's see. I think I shut it down. Crikey. Let me see if I can find it.
So do you need to acquire at 70% ARV to no? So that here's where that whole deal went down. Now, clearly they acquired that at a great price. They found a good deal. That was one thing. They did a little rehab. So they're in with hard money. They're at 210. So they were all in at 70% on the first, pretty much on the first lien, right? So when they sold it and they got the down payment, that's paid when we bought the note, when we bought their first lien, our money takes out their hard money loan. That's that they wrapped. So I don't know if I answered that.
So what I'm trying to pull up, I'm going to see if I can show this on the, let me see if I can show it on here. I already shut the other one down. I'm just going to pull up another one.
So real quick. So Steven asked, why would you want to sell the note instead of keeping the note on the entire deal? Well, that particular
You
deal
run
was
out of money.
They had a hard
Run out of-
money. Well, yeah, they had a hard money loan for one. And if you, in your hard money loan is a 6 to 12 month loan. So the way we do is we get 100, our relationships are giving us 100% financing, which is about what this buyer got. He has hard money relationships. So they gave him 100% financing on the deal, charged him interest, gave him rehab money. And so what happened is they went with a rehab and we're going to flip it and make a nice spread. They're probably going to make the same amount of spread that they had on the second lien, but they want cash flow. That's why they did that.
So I want to answer the other question about value, right? So
Yeah.
when a note buyer is looking at purchasing a note, he's looking at a couple things. So he's looking at the entire package of documents. That's number one. Okay, that all gets done through the transaction management process. You don't want to use, if you want to get max value, make sure you use one of the ones that we have in order to get you that. Number two, they're looking at investment to value, okay? What the property is worth versus what they're paying for that note. So let's look at this example right here. This one was 75%, okay? The sale price was 240, but the note investor only is paying 162. Okay. So the reason why we keep it at 75% or below is because it takes out of the equation some of the subjectivity of value. Okay. So let's just say, for argument's sake, that we sold it for 240, but let's say the real value is only 220. Okay. Well, because we wrote it at such a low first lien value, we're not going to get penalized, and we're still going to get the maximum value on the note sale. That's the key to this whole model. That's why we don't write it above 75%. And that's why, if you look at the new model, we wrote it at 72, because we can't see, for the last 5 years, it didn't matter because properties were going up in value. Well, so an investor would just, the property, if it wasn't worth 240 today, it probably is going to be worth 240 in 2 months. Problem solved. Well, we don't know. This probably might go down 10% in the next 6 months. So the investor wants to make sure that ratio is where it needs to be. That's why we set it at 72. So what we're seeing now is that you have less cash coming into these deals, but you're getting bigger second notes, because if you don't do it that way, you got to take such a big discount on that first lien. It wipes out a lot of the profit that you just, doesn't make any sense to give it away.
Hey, real quick. So if it's Stefan or Steven, but here's the best part about Damien. So Damien's deal he's talking about, he took over a house, property subject to. So let's just say for hypothetical scenario that 210 was at 5% interest. Okay. Well, now at 5, and I'm just doing round math, at 5%, which would be, that loan, let's just say it's $1,000 a month. Well, at 210 at 10, I mean, what was it? 1,800. I mean, it's another $800 a month in cash flow on top of the 350. So, plus the 350. I mean, that now cash flows $1,150 a month. So when you said, why wouldn't you keep the first lien in place? Well, you 100% would if you took over the debt at a lower rate and keep it. But this is hard money.
You can't. Everybody has to answer that themselves, because
Yeah.
everybody has a different propensity for risk. Okay.
Risk. There is risk
Okay.
when you do that.
There's a ton of risk.
Yes.
Let's be honest. Look,
Yes.
I can tell you this: when you sell that first note, there's zero risk. The risk is
Yeah.
gone.
Yep.
Okay. So you have to
Yep.
make the decision for yourself. That's why I don't teach sub 2, because there's risk. You cannot.
Hey, but
assess
Nick,
risk.
do you buy sub 2?
Doesn't mean I'm going to teach you how to do it, because I can go pay off debt tomorrow if I wanted to.
Right. No, but here's the thing. But here's the thing. This is why it's so important. We are at the best time in the history. I know we don't teach it now. But what I will say is that's why it's so important to create a first and second. Let it run for as long as you can, and then you have the opportunity to sell it if you have to, or pay it off. Now, Nick and I have the ability to pay it off with cash.
Well, we will. We're getting ready to update the our digital product. The price is probably gonna go up at least $1,000, and when in that new product, it will have that stuff in it. So if you guys if you haven't bought the digital product yet, but when we release the new 2.0 version, which is probably 30 days away, everybody will be grandfathered into that, whatever we add. But the price will go up. It'll have a little more creative component with all the new changes in it. And then we'll also have for the paid members also another private.
But you guys understand, like Nick and I have been waiting for this market for a long, like 10 years. So all the opportunities and the way to structure notes and all the things that we like geek out on every day to make money, getting the seller to carry all those cool things and how to create these offers, 3 or 4 offer letter of intents, all the cool stuff. I mean, that's what we're because Nick and I created this course out of just people don't understand. There's people that do buy notes. There's people that flip houses, but nobody does both really well that we can find. And so that's why we created this program. And now with all the stuff that's going on in the market, I mean, Nick and I mean, it's unbelievable. I mean, we went through it the other day. We're like, holy crap, there's a million. So we're going to go back to the drawing board, and we're gonna release it.
Yeah, but I want to get it very clear. Okay, find the deal, analyze the deal, sell the goddamn property and owner finance buyer. Get the hell out of the way.
Yeah,
don't do anything else. If you haven't done that yet, don't go try to do something else. Learn how to drive a car before you think you're gonna go drive at the Indy 500. Okay, you got to learn. You got to learn it first. You can't just go out and just just do it. You'll screw up, you'll make a mistake, and it will not be a pretty ending.
Hey,
Ask me how I know
Nick,
that.
we're going a little long, but if are you guys interested in just like what we would have done real quick? Sometimes that's why I like doing the nighttime ones, so we're not on a huge time crunch, but it is getting late East Coast side, but in the East Coast. But if Damien wants to share maybe some of the numbers and we can just plug in how we would have structured that deal, is that something you guys want to hear? Yes. Okay. All right. Do you want to, Damien, do you want to do that?
Yeah, that's fine.
Okay, here, I'll grab you. I'll bring you back on.
This is not the model to do it in. I can't do it in this
Oh,
model.
it's not gonna work. Okay.
I don't have the model.
We could get a ballpark if we want to just know the numbers,
I can do it. You know what I could do? Let's do this. We can do it. We can show it on we can do 2 amortization schedules.
Yeah.
It'll be close enough.
Yeah. I just think it's because of, obviously you guys know the opportunities. Is this oh, we're live here. Okay. I was like, wow.
All right. Can you see this is the first one? Can you see
Yep.
All right. So let's do this. Damien, let's do the underlying debt first.
Okay. So her mortgage was at, oh shit, I had it pulled up. I didn't know you guys were gonna ask. Let me see.
Putting some pressure on you.
Yeah, I was not even.
Dude, I look, the reason I just for myself, I just love this. The cash flow is so good on this stuff.
Yeah.
It's great.
Her underlying mortgage was at 184.
Okay.
I'm
And
just curious, how long was that in place? When was it?
So she only had it since 2020 or
Yeah.
2020.
Okay,
Perfect.
that's fine.
so it's
And what's the
basically
interest
brand.
rate?
So it's basically brand new.
Yeah.
What's the interest rate?
Interest rate was 3%.
Oh my Lord.
What kind of loan is it?
It was a 360 conventional.
Conventional? Okay, good.
Yep.
Not in 360 months is the term.
Yeah.
All right, so the P&I on this deal is about 775. That sound
Yeah.
right?
Yeah.
All right. I don't care about taxes and insurance. We don't make money on taxes and insurance anyway. The buyer pays it.
All that's passed through, right? So,
Passed
and that's the best part about doing these deals in Texas is because taxes and insurance are really high there, and all you
Yes.
care, and you get to pass that on. And as a landlord, you get to pay that.
So it was paid down for 2 years, September 20th?
Yes.
Okay. Doesn't sound like a big deal, but at 3% it does. It will. So I'm gonna start this one here. Okay. Now there's that amortization. Now I'm gonna pull up another one and we'll toggle back and forth. What did you finance? How much?
So hers was actually like a hybrid because I actually gave her some of her equity that she had on there.
So your wrap buyer?
No.
What did you sell it at?
What'd you
What'd you
sell it
sell it
at?
So yeah, the purchase price for the wrap
No,
buyer.
what'd you wrap? What was the loan amount of the wrap?
It was 330, but then I did 12% down. It was actually 330.
I just need to know the loan
Yeah,
amount.
the loan amount's 330, right?
No.
No, it's not. So me minus it down. So 330
290.
minus the 39600. It was 290. Yeah, 290 400.
There you go.
And what was the interest rate?
It was 7.5.
You know, Bank of America rates aren't even 7.5. You know that, right? Are you smarter than Bank of America? I'm just curious.
No.
I'm just teasing you, man. Just
All right.
All right. So let's figure out. So let's look at this. So their payment P&I is 2027. You're paying 775. So that's about 1,300 a month. But you're paying the seller.
1240.
How much?
It's like, well, 775 minus what? 2027.
2027.
Yeah, it's $1,252 in cash flow, just the arbitrage, not the pay down.
Did you owe some more money to the seller besides the cash? Are you paying her monthly payments also?
No, I'm not making a monthly payments. I have her doing payments every 3. So in like 18 months, I have over 10,000 more, and then another 18 months is 30,000.
And how are you gonna
But
pay
there's no
that?
payments in between.
How are you paying that?
It was gonna be through cash flow.
Okay. It has
So this
enough
is a,
cash
so
flow.
this is a $1,252 if you just a
How
simple
much,
math
let me ask,
equation.
hang on a second, Eric. How much equity do you still have to buy from her? How much more money do you owe?
65.
65,000?
Yeah.
Are you paying any interest on it?
No.
All right, so let's just do this. Let's just move this to, let's add 65, then that makes it 250, 249.
249. Yeah, that's what the purchase price
All right,
was.
let's do that. Let's just,
Oh, okay.
it'll make this a little bit more realistic, okay? All right, so now you basically, your 1049 is the out, the in is 2027. So your cash flow is what, almost $1,000?
Yeah.
Okay. So the question is,
And how much down did you get? Oh, you got 13%, right? Or whatever it was.
I got 12% down from the rep buyer.
do you have any cash left over after closing and expenses and everything?
Yeah, after everything, it was like 5,000 after
Okay.
everything. Yeah.
Oh, you're in again. So right now you have this, you basically have debt for 249, right?
Mhm.
Between the seller and the bank.
And
Okay.
oh wait, with the seller, did you put a second lien on it?
No, I don't believe so. I didn't. I didn't.
You just gave her a napkin and said, "I'll pay you whenever I pay you."
Yeah. No. No. There's a. Yeah. No. There wasn't a lien on it, but it was in the note. I don't know if that counted as a lien.
Oh, because you
It
did
just,
a
it just said in
you
the contract
you
that I
wrapped,
had.
you wrapped it.
Yeah. Yeah.
So there's a $249,000 debt on this property.
Yes.
Yes.
Yeah, and part of
That's
it's
left at
zero.
all 3%.
Part of it's 0%. Part of it's the underlying lien. Okay.
Yes.
Good. Yep. Yep.
All right, so let's look at this. So you wrote this, you wrote this at 7.5. So the total payout.
Is 330 real quick. Is 330 the value? Is the true value of it?
No. The ARV is like 275.
So 275 at 75% would be 206 minus 10%. So yeah, and that's yeah, you would have want to write that first lien at 185 and then the difference, right?
Well, we'll show that in a second. So, I mean, by writing it 7.5 instead of 9.5, look at the difference in over 30 years, okay? Just on this interest rate. You're at 7.5. Oh, hang on, gotta calculate the payment. It's $160,000
Yeah.
by you writing it at 7.5.
But Nick, the best part is you're not taking into account the pay down between the 3% and the 7.5 or even 9.5.
Well, we're gonna get there in a second.
That's a whole nother
right here.
ball game.
That's a whole nother issue, but we're gonna get to there.
No, it's good. It's a good issue. It's great.
Well, yeah, well, what if the Wells Fargo calls the note a year from now? Is it a
Well,
good issue?
that's why I said you want to create, you want to be able to create a first
That's
lien.
the problem with the deal is that
This-
something
we're
happened.
gonna sell you if there's a due, if a thing gets called due, what that note would sell for. That's what you're getting at,
Hell, yes.
which is about
Okay.
185.
The whole point of doing it. Otherwise, you might as well just freaking drive down the freeway without wearing your seatbelt and hope you don't get in an accident. It's the whole thing. I mean, we talk about this all the time.
Yeah.
So how much is you owe 249, right?
Mm-hmm.
But
Okay.
the true underlying debt is 185. You could probably negotiate the other part if something weird happened, but the real debt, not seller finance debt, is that 189.
Let's
right?
see here. So
184 is
Yeah,
the
so
underlying.
but you said it's worth 275, so 275.
Yes. Okay. Yeah.
75%.
Yeah.
But
you'd have to write the first loan at 275 times 0.75.
200, 206, 206.
206, okay? So 206 wipes out your debt, okay? So let's just think about that for a second.
That's if you sell it for par, but if you took a discount, it's still in that 185 to
Oh, that's right.
190 range.
Let me do that. So 185.
Yes, that's what I've been saying.
Okay, so 206 wipes out the debt, okay? So if you write it at 206 and you sold it at 290, right? That's a difference of how much? 84,000?
Yeah.
But let's just say you had to pay back the seller. That's another how much? 40 something?
It was a 40, 45.
All right, so that leaves you $39,000.
Yeah.
Okay. But the problem is when you write it at 7.5%, you're gonna have to give up such a big, I'll show you how much the discount in a second, but this is how it could have been. So you can still arbitrage it, okay? This is what you want it to be. So that if something hits the fan, you still are still in the deal, right?
Yeah, you still got a $39,000 second lien. Here's the deal. Like, just so you know, 4, 5, 6 years ago, I did a couple first liens like this with a sub two stuff. And I'm going back and refinancing those with the borrower when the time's right, and creating first and seconds, because just to protect the situation of a potential due on sale. That's what I'm doing.
Well,
Yeah.
it's not even that. It's the seller freaking getting sideways with you.
Well, here's the thing. What
It
I do,
happens. I'm telling you,
but
guys don't, no one understands this. This is so important. They
it does.
don't understand it.
It does, Nick. But what I've done in the past is I pay the sellers. I'm giving them a portion of the cash flow. So this particular seller on this particular deal that I'm talking about on a refinance, they're getting $150 a month for me for nothing.
That's great. But if Wells Fargo calls a note, that's not going to happen.
No, it's not. But I'm just saying that's what I did.
Right. So the structure on this would be so you have no cost basis, no risk, no liability. This would be your profit on the deal. Okay. If it's structured that way.
So what would you have the first? And so you have 290 at minus 206. You'd have a first for 206 and a second for 84, right?
No, because he still owes the money to the seller, the 49,000.
No, but that's the wrap a part of
He
it.
still owes the money though.
No, I know.
So his profit is $39,000 in a second note.
Okay.
And 9.5. That's what this shows right here. Structured correctly. That's not what you did. Doesn't mean you can't do it the other way, which you did. So this is how I would have structured it. I would have still wrapped it, but this would have been my lottery ticket that would let me stay in the deal. Okay.
So Nick, tell me what you would have, if you were going to structure this deal, what would your loans be? The first and second loans? Because I'm confused on what you said.
206.
206. What's the second?
And
What's the
whatever
second?
seller is 49. 206, 49, and 39.
Oh, okay. So the third, so you got a third lien for 39,000.
Well, he's got owes the seller money.
No, I know.
That
So
is
it's a first, second, and third. Then that's what you're saying.
actually the first, second, third, and fourth.
Okay.
Because there's two wrap liens. There's a first and a second on the wrap. There's a seller carry, and there's the Wells Fargo.
Okay.
Whatever it is.
Okay.
What it's actually for. Okay. So this is
what I would have done. This is what I would have done differently. I would have done the 206 minus the 290. I would have had 206 and 84 because I would have, because of the seller financing second at 0% interest. When do you have to pay the 84? When do you have to pay her money?
3 year.
Oh yeah, it's a 3 year 0% interest.
Yeah, so it's 18 months for the 10 and then another 18 for the 35.
So 45,000 divided by 36 months, which is $1,250 a month. That's basically doing.
Yeah.
I
don't. None of that matters because you owe it. I mean, you owe it. Doesn't matter. So it has to get paid. I mean, you can make it a little bit better and wait a little bit longer, but it doesn't change the fact that you still owe it. Right?
Pay it off. You're gonna have $100,000 in equity in your note.
Yeah, this number can only go up. It can't go down, right? Because you have something else writing in the thing. But here's where the issue is. Okay, let's just look at the difference on what the note is. If you write it to, let's just say you write it. Well, you wrote it. What'd you write the first lien at again? I'm sorry.
It was 184.
So you only write it 184. So I mean 184. Let's just look at to see what this is really worth. the first lien was 180. No, the first lien was not 184, was it?
Yeah.
184.
Well,
No, that's what he owes.
184 minus 290 is
No, he didn't write the
$106,000.
sell. How much did you write it to the seller for?
Oh, the seller.
I mean, the
290.
buyer. The buyer.
290.
How much is the buyer loan?
Oh,
290.
290. I apologize.
290. Thank you. So you wrote it for 290. Okay, let's just look at this for a second. 290 at 7.5%. Okay. You're probably gonna get if this was written at a 9.5% on that high of a rate, you're already over, your value is over, you sold it over value. So they're gonna come in and they're gonna say, I want it to be 270. Let's just figure this one out. Let's see what they're gonna say. They're gonna say, the rate's too low. They're gonna solve for this, so let's see what this comes out to be.
Yeah, because you're gonna have to solve for a 10% return or 11. Yeah.
So that $290,000 note is really worth $213,000.
Which now minus your 184, you're 29. And then
But you're probably gonna need to take that down another 15,000 or 20,000 because 290 is not the value of the property.
yeah.
So you're gonna have to adjust.
So did
okay?
you do 275 and 11 got you to the 212? Or I mean the 202, the 2027 and 11% got you to the 212. Is that correct?
Yeah, because I saw for the yield.
Yeah. Which is
But it
about,
was based on 290, but the property's not worth 290. It's
no, I
270.
know. That's
So I would probably take another 15 to 20 off of that number. It's probably worth 210-ish. Okay.
so think about this call tonight. Is you only did one of them. Like I can promise you, and I know because Nick and I are in a lot of masterminds, and I can promise you some of the biggest people out there teaching this stuff are not talking about this. And there's going to be a lot of
Here's
people
the other problem that's not in here.
big problems.
The other problem that's not in here, it's a first lien, so the investment to value is higher. It's going to even be a bigger discount because it's not a 75% first loan. It's actually 105% first loan.
Yeah.
It's going to crush you if you're never going to be able to sell this. You will not be able to sell this note and make profit on your deal because that value of that first lien is going to be, if you sell the whole thing, it's going to be worth less than what your debt is because of the way it's structured. That's why you got to make it in the first and the second. And that's why you got to do the rate. Otherwise, you'll get smoked. Okay.
So not to scare you, but
no, definitely. No, it was definitely insightful.
But you're fine on the arbitrage. You're fine. You're making money on it. You got to just be thinking about this kind of stuff because you don't know which way you're gonna go. Because there's gonna be times where you're gonna have to scratch a check. This one you made $5,000 or $6,000, right? What if you had to write a check for $15,000? They make that $40,000 note. Then what happens, right?
But how many of those deals are out there just like this, where someone just got a loan at 3% 12 months ago, 24 months ago? As many you can't. There's as many as you need. That's what I'm telling you. It's just structuring it right. So where the note buyers like us are if you need to exit out and there's an exit scenario, you're not losing all this time and energy and all this cash flow that you had. That's the $6 million mistake that Nick made. Now he still made a ton of money, but if he would have kept all these second liens rather than selling them off, you get 500 or 600 of those things at $40,000. Think about how much money was left on the table. That's just cash flow. We weren't even talking about the dang value of the note.
You're looking at a 3.5x over the face value of the note.
Yeah.
$1 million in paper is really 3.2 to 3.5 depending on what the interest rate is. So
so that's why we do this stuff, you guys. Like we want to share with the stuff, and then this is why Nick and I have actually over the last few months have been talking about adding some more material to the course on where we're at and what we're doing in our business, so we can share with you. Listen, this isn't, we're not talking about stuff that people don't know, but when you're doing it on a daily basis and where the market is and knowing and that's what Ken said, Kenneth said, this is a great call, because understand the value of the note is crucial, which is really crucial, especially if you don't create a
But
first. and
guys,
second.
I'm gonna say this for the 50th time, and I'll say it another 50 times. All you have to do is find the deal, analyze the deal, find the buyer, get out of the way. You don't need to worry about that if you follow the protocol. It's nice to understand it, because you know, but when you go and do it on your own, this is what happens, okay? You run the risk of losing more money as a result of it because of poor structure. That's it. So that's what we're preventing you from doing that, because guess what Eric and I aren't gonna do? We ain't gonna buy a note that you don't follow the protocol. I can promise you that.
Oh, yeah. So Damien, did you get it underwritten with an RMLO? Are you servicing the loan? Like, how are you doing all this?
Servicing the loan, but we didn't go through. I was gonna go through an RMLO, but I didn't think I really needed to, honestly, just to vet the buyers.
Why? So just curious, why do you think that? I mean, because it happens all the time. And why did you think it wasn't necessary?
Well, one, I know because it was under a short period of time, and second, it was just they gave me a guideline that I used as far as the questionnaires, as far as vetting the buyers that I use.
Like
Right.
you filled out a 1003 and got all that.
So let me ask you a question. When you go down to Bank America or Chase or Wells Fargo, do they do that? Is that how they run their business?
Not at all.
Okay, they don't. So I think the key to this whole thing is thinking, acting, and being a bank, okay? For two purposes. One, to protect yourself and doing things in best business practices. And number two, giving yourself an exit to get you most value if and when you need to liquidate, okay? That's why we do it, okay? There's a reason why we use servicers, the escrow, taxes, and insurance. There's a reason why we write promissory notes a certain way. There's a reason why we use RMLOs. There's a reason why we do everything that we do. It's to put ourselves in the best position to be successful and to get maximum value, but also to protect us because look, we're individual, we're entities here, and we're working with, you know, we're working with individual buyers, and that is not a fight you want to be in. I'm telling you right now.
You want to be able to, when a consumer says, oh, he didn't get all the information and I didn't really have the ability to pay. You don't want to have that. And when you do it, when you have an RMLO fully underwrite the deal and they sign off on it and stamp it, and so they have the ability to pay, and you go here, and the judge goes, well, you know, you did it. So it's just listen,
Look,
Nick and I've been doing this since 2004. I started buying houses with sub 2 and doing all this. So we learned all this from trial and error.
Yeah, I'm gonna show you one thing, and then I'm gonna wrap up. And this is not to scare anybody, because it's already done for you. You just need to use it. If you want to be rogue and go do it on your own, fine. But now that you understand why we do it, then it's really on you to make sure that it gets done. So I want to show you the last thing here. I'm gonna see if I can find this real quick.
But real quick, Nick, while you're getting ready to show, but 290 to 212, that's based off that's a $78,000 discount you may or may not have to take from writing a first only versus a first and second. That's just conservative. If you had to exit out. Right?
The national average that we have reported on a performing first lien is about 82%. That's what you'll get.
Which is
outside of us.
Which is 168,000, which is 15,000 less than what you owe on the first lien, not the second.
That's why you want to shove as much to the second lien, because guess what you don't do? You don't discount the second. It's your note.
Yeah.
See, that's why we don't want to. We want to.
The cool thing about creating first and seconds, if you have to discount the first, you just discount the first, but you keep all the equity in the second lien.
Mm-hmm.
You don't lose the money. So God forbid you had to write a $10,000 check to buy this deal and create a first and second, sell the first, keep the second, but you still have a $70-some thousand second lien. How many 10,000s would you invest to have $70,000 second liens? A lot.
All right, so I'm going to share this because this is really because of what Damien just said. So let me pull this up. I'm going to show you this. Okay. Here's what the file should look like when you're done with it. Okay. Here's everything on the buy side. Here's all the documents that are on the buy side when you bought the property. We still want them. And there's just taking a long time to pull up because I'm streaming right now. Here's pictures, draw request, sales contract, assignment, proof of deposits, insurance, applications, settlement statement, owner title policy, recorded warrant. Did you get an owner title policy when you closed this?
Yes.
Did you get a lender title policy also?
No.
Why not? Didn't think you needed one?
Yeah, I just didn't think I need one. I just
Who
thought I
told you
had to-
that? Did you sell that to yourself, or did somebody at the title company tell you?
No, no one told me that. I just didn't. It just didn't come to mind.
Title company didn't ask you if you wanted a lender title policy, or did they?
They're talking about the title company.
Yeah, did they ask you for if you wanted a lender title policy?
No, no, they didn't actually.
Interesting. Wonder why not? Because a good title company would ask you that. But so anyway, these are the documents. Okay, and I want to show you. The main thing is I want to show you is on the sell side here. Okay, so I'm going to show you.
But obviously, you guys, in the program, we teach you, it's all in there. We gave you all step-by-step on exactly what to do. I don't know, Damien, did you buy the digital product?
Oh no, this
Okay.
is my second time on with you guys.
Okay, so can you see the bottom of this page right here? So Damien, this is what you didn't do, okay? I'm not saying you're saying if that was your first deal, according to Dodd-Frank, you're allowed to you get 3 for free, right? 3 or 5, depending on how
It'll
you
be
do it.
24 later, who knows? But
Okay.
anyway,
Okay.
you're fine. You're gonna be
This is
fine.
a 142 page document.
Mhm.
Okay. So my file has a 142 page file document. This is just one document. I just showed you everything else. I mean, go through it. Your file does not. Okay. So now you see when you start comparing value and you start assessing risk and all this stuff. But let me show you why this file is so important to do. Okay. Okay. And go right down here. So this is the approval letter. Here's the credit report. Did you get a credit report on your buyer?
No.
Okay. Credit report here. So this one, let's see if they see if this shows me the credit score. I think this is probably.
The best part about this is you don't have to do this. The RMLO does everything. You're just padding your file to make it more
It
valuable.
just gives you one more layer of protection. I mean,
Yes.
well, let me show you. This stuff's fine. I don't have a problem with this. Okay. I mean, this is not the important thing, but I want to start getting to the disclosures. Okay. Let's just see what's see.
We're not going to read all 142 pages.
No, I'm just trying to see. I think we
Looks like,
redacted. I
Lord.
think we already redacted.
Ready to
stuff.
go.
I'm getting, okay, here we go. Here's the first disclosure. Notice the home loan application. Okay, blah, 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 blah. Talk about this, blah, blah, that. Please acknowledge your receipt. Okay. It just talks about disclosures, right? On about their credit score. That's just one disclosure. Okay. Your credit score and the price you pay for credit. Okay. Another thing right here. They signed this too. Let's keep going down here. Notice the home loan application. There's 2 buyers on this. So there's probably 2 copies of this. Okay. Here's the loan application. Here's the loan estimate right here. Okay. 9.75, 172,000. I want to get to I don't care about this. This is all part of it. Okay. Intent to proceed with the application. Okay. You have applied for a mortgage loan covered by TILA and RESPA. Okay. Also in accordance with TRID. There's a reason why this is there, guys. Okay. There's a reason why these government bodies exist, and they're not to protect you as the lender. I can tell you that right now. They're to protect the buyer. Okay. Let's continue on here. Here's the application. It's a 1003 application. It is the uniform residential loan application. Exactly the same as gets used by any other lender to do it. Let's keep going down here. There's more.
And keep in mind, this is not to intimidate. It's just to protect everybody that does this.
All I do is look at a couple of things on there. I don't do anything. This is somebody else's job. Remember,
Yeah.
I said, find the property, figure out if it's a deal or not, find the owner finance buyer. Did I say underwrite the buyer and send them through RMLO? No. Did I say to get a lender title policy? No. Did I say have the borrower fill out an application? No. Why didn't I tell you that? Because you don't need to do it. That's somebody else's job. Okay. That's somebody else's job to do that. Okay. But it needs to get done. Let's get through this here. Let's get through some of this other stuff.
It's like when you go fix and flip a house and you outsource everything. It's the same model. We're just not touching any materials.
Acknowledgement and agreements. This section tells you about your legal obligations when you sign this application. Pretty important to tell the buyer what their legal obligations are, I would think. Okay. Okay, let's get going here. Military service, sex demographic information. Okay, loan origination form. There's other stuff in here. Let's see here. There's like 30 disclosures in here. This is still in the application. I'm just trying to get through it here. So we get to the disclosures here. Borrower certification and authorization. Love this one. This basically says they didn't lie on their damn application. Because they lied and they go and you have a problem. Guess what? They sign it. Okay. They sign it. They got 3 or 4 things. Authorized to release information. They're authorizing us to release information. That's another disclosure. Okay. This is a second version of this is because there's two buyers on this file. So some of this stuff is going to repeat. But I love this one. Who knows what an anti-steering loan option disclosure is?
And then when like you don't try to
I don't know. I don't really care. All I know is that my buyer signed it and it's in my package and it was probably put in there for a very specific reason under Dodd-Frank. And why? Because I guarantee you the bank has this in their package. You go down to Wells Fargo to go apply for a home loan, you're signing this document. You're signing all these documents, by the way. Okay. Oh, Texas Mortgage Company disclosure, another disclosure.
And here's the other thing.
Equal Opportunity Credit, Equal Credit Opportunity Act. Guys, these are, I tell you this, not so you have to learn to put these in yourself. They're already there. Just use it.
But that's no, Nick, the reason you're saying this is if you do this, how much more value is your note? You're not the national average. The reason notes sell at 82% because nobody does this stuff.
This doesn't exist.
They use it against you when they buy your note.
100%.
Yep.
100%.
Yeah.
You're going to go, Damon, you're going to go sell your note and go, hey, where's the credit report? I didn't get one. Where's the RMLO file? Didn't get that. That's 2-point deduction. Yeah, did a buyer, blah, 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 blah. Continues on. More disclosure notices. Affidavit of occupancy. What are you going to do with the house? All right. They make it a primary residence. They call it a primary residence and they turn it into an investment property. Guess what? They just violated their freaking terms of their deal. Anti-coercion statement. Fair Credit Reporting Act. Flood Disaster Protection Act. Okay. Hell, it just rained like a mother in Dallas. What, last week, Damien?
Yeah.
You think any houses flooded last week?
Probably a few.
Probably
Definitely.
a few. Okay. Servicing disclosure statement. Okay. Honestly, I don't really care about any of this personally. I do. It doesn't matter. I just, it's RESPA here, man. It just goes on. I'm only on page 45, guys. We're not even close. Initial escrow account disclosure statement. Damon, and I know you put that in there, right?
I honestly I don't think it was in. I don't know what all the files that was in there.
So what you did is there's nothing wrong with what you did. Okay, let's make sure we clarify this. What you did, it didn't sound like you broke the law. Okay, all we're saying is that it's not a clean, pristine file, right? It's got a bunch of scratches and dents in it. We talked about the if you have 2 cars and they're both the same and one's been beat to crap with a bunch of dents and scratches and no maintenance and the other one's in pristine condition, which one's worth more, right? Same difference. Yeah. Notes are the same way. Okay. So right to receive an appraisal. Okay. Appraisal evaluation acknowledgement. Okay. Patriot Act information disclosure. These are all required documents. Another Patriot. I don't know why there's why all those are in there. Requests for transcript of tax returns. Disclosures and consents. There's like 30 something in there. I'm going to stop now. But guys, the bottom line is with this, you don't have to do any of this crap. It's already done for you. You just get it in, send it to the transaction management company, depending on where it's located. It could go in one of a couple different directions. their job and sole responsibility is to take the signed application or the signed purchase sale agreement that you execute as the seller with the buyer and take it and get it across the finish line all the way to note exit, to the note sale. That's what they do. Okay? All that crap in the middle, you don't have to mess with any of that stuff. Okay? You got to provide the initial information that's requested, and then you get the hell out of the way and let them go do their job so you can go figure out how to do another 2 or 3 deals while this is all in the process. That's the idea. Okay. So yeah, you get another one, send it over. Let's structure it. Let's structure it and make sure we get it as
especially in Texas, so we might be able to.
Oh yeah, I got I think 2 more I'm looking at, so I'll definitely send you guys away.
take the model. Are they sub 2s or are they different kinds of acquisitions?
Both are sub 2s. Yeah.
Okay. Well, we'll have to look at it a little differently, but it doesn't change it very much. We'll just run the dual amortization, and all we're gonna do is structure the first and second liens big enough, the first lien big enough to cover the first lien, the underlying debt payoff.
If it's called due.
Because, or
Okay.
we have to liquidate for some other reason.
Yeah.
That's it. And then you can and underwrite the buyer to make sure everything's serviced and escrowed and all that stuff. Okay.
Okay. Yeah.
All right. Cool.
Cool, man. Hey,
I
David,
appreciate it.
thanks
Thank you.
for sharing. That
Yeah,
was-
thanks for-
Absolutely, no problem.
Thanks for
Thank you
letting
guys for the
us pick on
information.
you a little bit, but no, it's
Oh, no,
really,
no
really
worries.
important because, you actually did a really good job. I mean, compared to what most people do, it's actually a good job because there's a lot. I mean, I didn't know. Look, I didn't look at your sub two package. I didn't see if you had an MOA and the power of attorneys and all that stuff. I'm hoping that you have all that stuff correct.
Yeah, I did.
Who closed that for you anyway?
Kane title.
Kane?
Yeah.
All right, cool. All right, I think we're about wrapping up for the
Cool,
evening.
man. See you,
Any
David.
other questions that we have?
Yeah, we had one more question. So Jose had a question. Can you buy deals near or at market value? And then it says, and not have money in the deals. Well, the buying at market value, here's the way I look at it. You can buy at market value, but if you can get a big enough down payment and a big enough arbitrage, you can still make money in this business. If you find enough buyers that have good down payment money, you can make it work. And then going back to what he said and not have money in the deals. Well, we just went through, and Damien, we didn't actually go through this, but he almost had $40,000 in a down payment there. So there's money in that deal and there's cash flow in that deal. It's just more on the structure of it. But there's a lot of these deals where, I mean, you and I, we try to structure these deals. Well, we're in a different. I mean, if I had a $40,000-$50,000 second lien paying $450 a month, and I had to cut a check for 10 grand, would I do the deal? The answer is I absolutely would do that deal. Not everybody has that extra money to do it. It's just, you just got to play around with it. But this is as well as another part of what you and I people are asking these questions. So we're going to create information for that. Is how do you do a deal when you're out of pocket 10 or 15 grand, but you got a nice big fat second lien. So we're actually going to talk about that in the future about how we do it and so you're just building this big war chest of second liens and cash flow on these deals over time. So I think that's it. What else? You got anything else, Nick?
No, I think we're good. Any other questions? Let's just check the bottom. No, that looks good. Excellent.
Oh yeah. So a little housekeeping. You've got our Facebook in this chat. You've got you got a 45-minute discovery call, our digital products right there. You got our resources. You've got our Facebook group. I mean, Nick and I are, just so you guys know, we love all the activity in the Facebook group. We're not in it all day long. We gather it and then we want to share it with you guys. But I don't know, between Facebook and here, we have probably 50, 60 people watching this, so we can actually provide the one-to-many answers, so you guys gather it and learn it that way versus doing it one-to-one. It just isn't efficient. So we appreciate you guys being on the call. It's a little bit different time. I think we were able to spend a little more time on it too. I guess we're a little bit long. So East Coast, you guys can go to bed, I guess. And
Good night.
and we'll chat with you guys later. We'll see you next week.
All right, guys. Have a good night.
All
Take
right,
care.
see ya. Thanks.
All right.
Bye.